Hi everyone, welcome to FinBytes. This is a very important video from the investing point of view and have explained my own strategy on how I generate higher returns. So watch the video till the end as you will be learning many things along. With reference to our previous video on mutual funds, we will be looking into most common methods of investing into mutual funds. If you haven't watched the part 1 of the video, where I have covered about basic terminologies used in mutual funds, check the video link in the I button and then watch this video. The main objective of today's video is to learn about lump sum investing, its meaning, pros and cons, and when to do lump sum investing, and SIP. Again, the same 3 parameters will be discussed. Towards the end, we will compare both investment options and strategy on how to effectively use both. Lump sum and SIP investing can be done across all the asset classes such as mutual funds, direct equity, gold, cryptos, etc. With this, let's get started with today's video. Lump sum. What is lump sum investing? Imagine you have been working hard for a particular project since a year, and towards the end you have successfully completed the project for your client. Client is very happy and he pays you a bonus of say rupees 2 lakhs apart from your daily or hourly wages, which you used to pay on a monthly basis. This 2 lakhs at the end of the project, which client paid, can be considered as one-time payment or lump sum. Now, if we want to invest this 2 lakhs in one shot in a mutual fund or a stock for certain long-term goal, we call this as lump sum investing. Pros of lump sum investing. Lump sum investment can be made at any point of time based on our cash flows. If we are doing a lump sum investment, we would be giving more time for our money to be invested in an asset class, which indeed increases our returns. Cons of lump sum investing. If we are not updated with the current trend or not well versed in the capital markets, we may end up losing money in a shorter time frame by investing lump sum into an equity mutual fund or a stock. The reason for this is simple. After we invest a lump sum, if the market falls, then there would be losses in our portfolio until market recovers. So, when is lump sum investing better? If we are good at somewhat timing the market, we can make good returns. For example, if anyone would have dared to invest lump sum during the COVID fall or during any other major global crisis, one would have made easily 1 to 1.5x in mutual funds or 3 to 4x returns in direct equity. If we are good with technical analysis, we can also invest in lump sum at various key levels of stock and index to make good returns. SIP. What is SIP investing? The full form of SIP is Systematic Investment Plan. Let's take the same example which we took for lump sum. In that example, that person used to receive wages on a monthly basis. Let's say his monthly wages is around rupees 1 lakh and he decides to save rupees 20,000 every month into a mutual fund scheme or a stock over a period of time, say 5, 10 or more years. Then it is known as SIP investing. So, he will be investing a particular sum of money in a particular time frame over a period systematically and consistently. Then this is known as Systematic Investment Plan or SIP. Pros of SIP investing. The first advantage is rupee cost averaging. The risk of downside will be limited as we will be investing every single month or week, irrespective of whether market is rising or falling. If markets are in a rising trend, which is a bull trend, we tend to acquire fewer shares or stocks. Similarly, if markets are falling, which is a bear trend, we tend to acquire more units or more stocks. This table helps us in visualizing how averaging work at various market conditions. Since we were investing every month irrespective of market condition, the averaging was continuously happening. Towards the end, we were able to generate rupees 1,764 more when compared to lump sum investing. The second advantage is its flexibility. At any point of time, we can either pause a SIP or cancel it for some period of time. The third advantage is discipline. SIP followed over a period of time will help us in cultivating the habit of savings, as we will be investing a particular amount in a disciplined manner for a particular period of time. Cons of SIP investing. I would not say this as a disadvantage, rather a minor drawback for people who are willing to take lesser risk. SIP returns are lower in consistently rising markets. So, when is SIP investing better? If you are not willing to take higher risk, SIP would be a better option as there will be a continuous averaging. Comparison between lump sum and SIP. Usually, SIP gives higher returns in a falling market. To prove this, let's take a scenario where we invest Rs 20,000 every month in X fund. We start to invest from Feb 2017 and withdraw full amount on Feb 2022, which is a period of 5 years. We made a simple assumption of market going down by 1% every month from Feb 2017 to April 2020, and after which it will be increasing at 1% every month till Feb 2022. This is reflected in the NAV column where prices are dropping till April 2020 and from then on NAV is increasing. The other two columns are amount invested every month and units allotted according to the NAV. Towards the end, after 5 years, when we withdraw the fund, the current value of the fund is Rs 12,76,682 rupees, whose XIRR or extended internal rate of return is 2.44%. Similarly, if 12 lakh is invested fully on Feb 2017, which is a lump sum investing, the value of that fund on Feb 2022 would be 10,19,520 only. In absolute return terms, it has delivered a negative 15.04%. And if we consider a CAGR return, even that has a negative 3.21%. So this proves us SIP is a better option in a bearish market. Usually, lump sum gives higher returns in a rising market. To prove this, let's take a similar scenario where we invest 20,000 every month in X fund. We start to invest from 2017 and withdraw in Feb 2020, which is a period of 5 years. We made a simple assumption of market going up by 1% every month from Feb 2017 to March 2021, and after which it will be decreasing at 1% every month till Feb 2022. This is again reflected in the NAV column where prices are rising till 2021 and from then on NAV is decreasing. The other two columns are amount invested and unit allotted according to NAV. Towards the end of 5 years, when we withdraw, the fund current value would be 13,43,650, whose XIRR return is positive 4.46%. Similarly, if 12 lakh is invested fully on Feb 2017, which is a lump sum investing, the value of that fund on Feb 2022 would be 17,49,480, which is significantly higher than SIP investing return. In absolute return terms, it has delivered 45.79% return, and if we consider CAGR return, it has delivered positive 7.83%. So this proves us lump sum is a better option in a bullish market. Check out for the link in the description to download the SIP and lump sum calculation sheet. You can plug in your real NAV values of mutual fund and check out on SIP and lump sum investing. So now you might be confused, what should one follow, either lump sum or SIP investing? From the previous case study, we can conclude that both SIP and lump sum have their own pros and cons. Let me tell you what I am doing which has given me better returns consistently over a period of time. First, start a SIP immediately. It doesn't matter if you have knowledge in investing or not. Start a SIP as soon as possible. The beauty of SIP is you need not time the market, as it takes care of market fluctuations by averaging. If you have a bit of experience in investing, start picking good equity mutual funds in mid-cap or small-cap sectors. Or if you are a total newbie, start investing in passive funds. passive funds will replicate a particular index. Index might be Nifty 50, Sensex, Mid-Cap Index, Small-Cap Index, or anything. You need not worry about short-term volatility if you're planning to invest for long-term. Second, start to learn about investing. This is an important skill that everyone should learn and master. You can subscribe to our channel to learn more about investing and other financial related topics. Third, once you start understanding how market cycle works during the key support levels or at any distressed times in the economy, such as COVID breakout, war breakouts, invest in lump sums. The combination of both SIP and lump sum will give us a better returns. No one in the world can time or predict the market moves accurately. So start with the SIP and during key levels or any distressed times in the economy, invest in lump sum. With this strategy, I was able to generate better returns over a period of time. One important advice from my side is only if you have patience of not taking out your money from the equity markets for at least 5 years, then only enter into equity markets. Otherwise, stay invested in less volatile instruments such as bonds, golds, etc. If you like the content, press the like button. If you are visiting our channel for the first time, subscribe to our channel and press all notification bell icon to not to miss any future videos. Thank you and have a great day. Bye.